Today, we're going to introduce you to bridging loans. A bridging loan is a special type of short-term loan that covers the financial gap between the purchase of your new property and the sale of your current property. What's great about a bridging loan is that it gives you the flexibility to buy a new property before you've sold your existing property. So it gives you more control and takes the stress out of having to align the sale of your current home with the purchase of your new home. So how does it work? Let's look at Sally's situation as an example. Sally is currently living in an apartment block in Sydney, but she's been looking to move into the suburbs and upscale to a slightly bigger home, so she puts her apartment on the market. Before she's able to sell her apartment, she finds the perfect home. She really doesn't want to miss out on the chance to buy her dream home, so she calls up her mortgage broker Daniel from Finance Harbor Networks, who suggests applying for a bridging loan. Sally initially took out a home loan for $480,000 to buy her apartment. While she waits to sell the apartment, Sally applies to have her apartment's home loan become a bridging loan. For her new house, Sally is approved for a new loan at $720,000, so she now has a combined home loan balance of $1.2 million. During the bridging period, and while she waits to sell her apartment, Sally makes interest-only payments on her home loan's combined total. After 8 months, she sells her apartment for $520,000 and pays the bridging loan. She puts the remaining $40,000 in profit towards her new home loan and reduces it from $720,000 down to $680,000. She can now continue paying off the principal loan and interest payments on her new home loan. If she sold the property at a loss, the amount remaining in the bridging loan will be added to her new home loan. Now that you have an idea of how a bridging loan works, we'll have to get into the nitty-gritty details. Bridging loans are structurally different from lender to lender, but you can expect it'll have a limited loan term. In Sally's example, her lender gave her a 12-month bridging period. There are usually special conditions attached to the timeframe, like paying higher interest rates if the property is not sold in time. Generally, banks will want you to show them that you can pay at least the interest-only payments on the combined loan during the bridging period. Lending money is not without risk, so you'll have to weigh up the convenience of having a bridging loan and its possible risks. If you don't sell your home in the set time, you could be left with a huge interest bill or risk the bank stepping in to sell your home. If your property sells for less than you expect, you could also be left with a larger ongoing loan amount, which could risk putting you into financial difficulty, so make sure you have a backup plan. Another thing to keep in mind is that interest is usually charged every month. So the longer it takes to sell your property, the more interest your new loan will tend to accrue. There are a few requirements that may apply to bridging loans that wouldn't apply to other types of home loans. Depending on the lender and specific product you choose, you may have to pay a deposit of a certain amount to apply, usually around 20% of the combined loan total. So your bridging loan and your new loan. Another condition may be that you won't be allowed to use a redraw facility on the bridging loan during the bridging period. So hopefully that gives you a basic idea of what bridging loans are and how they could possibly help you. Working with a mortgage broker can make the whole process a lot easier. Not only can we advise on whether a bridging loan would be best suited to your circumstances, but we can also help polish the application for your new home loan to make sure it's accurate. With banks clamping down on applicants with stricter lending rules, you'll want your application to be perfect.